Gold has reclaimed global attention. In 2025, its price surpassed $4,000 per ounce, the highest ever recorded. But this is more than a market event. It's a reflection of deep structural doubt in the modern monetary order. As John Maynard Keynes warned, when confidence fails, gold becomes the final certainty. The question is, whose confidence just failed? The investors or the systems? By October 2025, gold trades near $4,050 per ounce. Central bank purchases exceed 1,000 tons annually, the highest in 5 decades. China, India, and Gulf economies collectively hold around 25% of global official reserves. ETF inflows to physical gold surged 40% in 1 year. UBS expects an end 2025 average near $3,800. Goldman Sachs projects $4,900 by mid-2026. Every figure points to the same reality. The world is migrating from promises to possession. In 1971, the Nixon administration ended the dollar's convertibility to gold, liberating governments to print value at will. Since then, every crisis, the Asian contagion, the 2008 collapse, the pandemic shock, has been met with more liquidity, not more discipline. The result? Debt expansion without limit and currencies floating on political credibility. Over the last 5 years, central banks began to rebuild the very anchor they once abandoned. Gold re-entered the bloodstream of finance, not as nostalgia, but as insurance. The decisive shift came when emerging powers stopped treating gold as protection and started using it as leverage. Over the past decade, BRICS central banks expanded holdings by more than 30%. They are redesigning the foundation of reserve power, trading dependence for autonomy. This is the financial front of de-dollarization, a slow but deliberate transfer of authority from Washington to vaults in Beijing, Mumbai, and Riyadh. As La Casa de Papel declared, "We're not stealing money, we're manufacturing it." Today's nations are manufacturing monetary independence, bar by bar. The US national debt exceeds $36 trillion. Treasury bonds, once the world's safest asset, now carry political risk. Monetary authorities who once anchored faith in the system are now part of the uncertainty. Gold's ascent is not speculative, it's corrective. A quiet recalibration of trust from infinite supply to finite value. Ray Dalio captured it precisely. When trust in paper is lost, moving to hard money is not a choice. It's survival. This is the structural message behind every ounce purchased. Discipline, not fear. If inflation persists and interest rate cuts return, gold will remain the neutral reserve, a monetary Switzerland. In a baseline path, prices stabilize between $3,500 and $4,500 as nations settle part of trade in bullion. A moderate scenario introduces tokenized gold, digital units backed by vaulted metal, merging tangibility with technology. A disruptive scenario sees a hybrid system emerge, where gold, yuan, and digital currencies share settlement duties. Each possibility weakens the dollar's singular dominance and strengthens the logic of scarcity. A return to hard assets brings its own vulnerabilities. Excessive hoarding could dry liquidity, slow growth, and redirect capital from innovation to storage. For developing economies, parking reserves in bullion rather than infrastructure is a hidden tax on progress. If commodities begin trading in gold terms, currency volatility could reignite. And for the United States, a reduced reserve privilege means higher borrowing costs and diminished geopolitical leverage. Every system that anchors too deeply to scarcity risks becoming brittle. Gold's climb beyond $4,000 is not an ending, but a reckoning. It shows a world rebuilding trust on something tangible, finite, and beyond policy manipulation. Yet every return to metal has meant a return to constraint. Can the world balance confidence with flexibility, or will the search for security once again chain the global economy to its own past? If strategy, history, economics, and finance shape the world, this is where they converge. Subscribe now and join the conversation.